Stephen talked about the scope of automatic enrolment and actually contribution levels, and I'm here to talk about how can we make your money or savers' money work as hard as it can. And so time was that many of you in this room will have probably offered a defined benefit pension. That meant that you offered a set income in retirement to your employees even, and you bore the risk if those investments fell short. Now, most savers are in defined contribution schemes. They bear the risk of their investments, and they're faced with an incredibly complex choice. At the end of their retirement journey, in an inertia-based system, they have to turn their pension pots into a retirement income. And over the last decade, we have seen a pension saving revolution. So we have seen, as Stephen said, private participation rates double, and we've seen saving increase across all ages. Actually, the highest increase in saving has been between those aged 22 and 29, which has gone from a quarter in 2012 to a participation rate of around 90%. That is a fantastic success. Although if you asked your staff, they probably wouldn't know much about it. And that's because you, the employer, has picked the scheme that they are in, and the trustee or the provider has made all the investment decisions. So around 97% of your staff will stay within the default arrangement. Ultimately, that means that you, the employer, and the scheme is almost the entire determinant of a good retirement outcome. No pressure. So, what can we do as an industry to get this right? Well, we can focus squarely on saver outcomes and on value. And that's why we at the Pensions Regulator have recently consulted and fed back on a new proposal for a value for money framework. What we want to do here is get schemes and employers to assess value for money in pensions. And what do we mean by value for money? Well, we mean the investment performance and the quality of service you receive for the price paid. And we think the best way to do that is to get the schemes themselves to disclose metrics across investment performance, costs and charges, and quality of service. Now, I'm conscious that there are many pension luminaries in this room as I look around, but I'm going to explain to you how pensions work. And you require a number of metrics because investments are made differently depending how far the saver is away from retirement. Typically, there are three phases. Growth, when the saver can take more investment risk because they aren't going to act on their pension anytime soon. De-risking, between 10 and 3 years from retirement, where savers will still want some returns, but they'll want some stability as they approach decision-making time. And then finally, at retirement, where savers will want a stable income in order to make a good decision for them about their retirement. And across those phases, you need to look at a number of metrics over a number of years, risk adjustments, and also considering what the scheme is aiming for in the future. It's not an easy task. And I know that actually, for many of you in this room, the HR directors, you have a lot on your plate at the moment. And increasingly, pensions is going to be a consideration within that, because I'm sure that you, the large employers in this room, will consider it to be an important part of your retention and reward policy. So what do we have to do here? Well, I'm sure that some of you are advised by employee benefit consultants. They may provide some of these metrics to you, but it won't be standardized, and comparison will be very difficult across the market. Some of you are on your own. And what's guiding you in that decision making? I'm guessing, almost universally, it's cost. And why is that? Well, cost is always disclosed and it's easy to understand against these projected metrics or risk-adjusted returns. That makes complete sense. And master trusts are competing far below the charge cap of 0.75% because they know that's how you make decisions. But we also know that although fees might be the same across master trusts, performance and the services you receive can vary greatly. Now that could be fine. You know, we don't want homogeneity in the market, and you have different employees who require different things. But we do want that difference to be the product of informed decision making, not just as a byproduct from a lack of engagement. So what we're trying to do is focus minds on the metrics that matter and really give you the power to drive competition on value for money. Now, this framework, as you may be aware, will require primary legislation, so it won't happen overnight, and we'll have to consult a little further to get the detail of it right. But in the meantime, there are a number of other pensions initiatives which are really going to impact your decision-making on value. So earlier this year, you might have heard the Chancellor's Mansion House reforms, where there was a raft of pension measures, mostly focused on DC. And there are two in particular that I think really are a consideration on value. The first is on decumulation, a nonsense jargon term for spending a pension. And what the government is proposing is that all schemes should either offer or partner with a provider of decumulation products. And why does that matter? Well, as we talked about earlier, savers have a pension pot when they come to retire. They don't know anything about their pensions and financial literacy is low. So it's likely you're going to need a variety of products to help them manage longevity risks, manage those blocks in the road that happen in retirement, and help them really cope with the future. So that is going to be a big consideration for you as you start to pick your pension provision. The second is a brand new kind of pension scheme. So collective defined contribution schemes were first brought to the UK this year through Royal Mail, where the first scheme was authorised. But what the government is proposing to look at is multi-employer CDC. That is where investments, individual investments, are pooled together, and at the end of a retirement journey, you are given a retirement income rather than a pot. It's a bit like a defined benefit pension scheme, but one crucial difference. You're not guaranteed that income. So there's a lot to be worked through before this can actually hit the market, but it may be a consideration for those of you that want to provide greater surety in retirement. So, as I said earlier, as a regulator, as industry and employers, we need to drive value for money, and all savers deserve value for money. So if I can ask you to do one thing from today, is to really ensure that when you're picking your pension provision, you're looking at investment performance and quality of service for the price paid.